You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, and welcome to Masters in Trading Live. Thank you. Thank you. My name is Jonathan Rose, and I get on here every day the market's open, 11 a.m. Eastern Time. Go over the market, share some thoughts. Once in a while, we'll share our trade of the day. I got the chat open. Good morning, George, Giuseppe, Jeff, James, Bill, John, Harry, Allie, Chris. Thank you all for joining us. Really appreciate it. Again, we get on here live every day the market's open. What are we going to discuss today? Hey, Greg. Today, we're going to discuss something very important to all option traders, and that's going to be the expected move, okay? The expected move is it's really the straddle. Whenever you look at a new options chain, you want to look at what's called the straddle. The straddle is going to show us the expectation of movement. And so I'm going to show you an example today. Riz, what's up? Hey, Greg, Harry, thanks for joining. So I'm going to show you a couple of examples today because I want you to see how volatility plays in pricing options. The Black-Scholes model has got 6 inputs. 5 of them are fixed. There's only one thing in the Black-Scholes model that we need to figure out, and that one thing is volatility. Everything else is given to you by the market. So that stresses the importance of this topic. Let's go to the screen. Let's have some fun. Hey, Madeline, thanks for joining. Okay, we're going to start here because yesterday in our Discord, let me get my pen, which is somewhere around here. Mr. Pen, there she is. Okay. Hey, Eric, thanks for joining. So yesterday we have our Discord community where we're talking about the market throughout the day. Market was kind of weak yesterday. Last trade, 534 right now. So this is a weekly chart. 532 is support. Now, this is this week. The previous week, 3 and 4 weeks ago, the high of those was 532. We talk all the time about weekly highs and weekly low, how important they are. So this support, which ended up being the low of yesterday, and again, it's the low for today, we need to take that out if we're going to see any follow through to the downside. Whenever I'm doing technical analysis, I want to keep things super simple. Watch that 532 level. We're going to need confirmation from those short-term VIXs to get through those key levels. Okay, hopefully you can see, and this isn't too small, so let me open it up a little bit. And I want to show you, we're going to look at Lemonade. Okay, and Lemonade is trading at $36. Okay, Lemonade is trading at $36. And so we're going to look at the straddle. Whenever you're looking at a straddle, you want to look at the money. When you do a straddle, you're buying the at the money call and you're buying the at the money put. So right now, the straddle for Lemonade, call that, say, 480. And the 36s, mid-market, we'll call those 470s. And if we add that up, it equals 950. Okay? So the straddle is 950 in Lemonade. I'll explain exactly what that is. Down here on Thinkorswim, on any of your platforms, you can look at the straddle. The straddle is 920 at 980. Okay? I just valued it at 950 up above, which is just the mid-market. So if you do an order like this, you can buy it with one trade as a straddle, or you can do it as two legs, buying the call and buying the put. I want to stop there and ask you guys if that makes sense. We do get a question. We just had this question in our Discord. I believe it was this week. And the question was, JR, if you're looking to do a spread trade and a straddle is a spread trade, would you do that trade using one ticket? And using one ticket, you would come down here and you would buy these 980s, and that's buying the calls and the puts. Or would you go and buy each separate leg? Now, the answer for me is I'm going to always go and buy each separate leg. That's just how I'm going to do it. I'll get better fills that way. But if you wanted to do the order as one straddle, I would work a bid. 940 bid, limit order. Hopefully you get filled. But overall, it gives you a little bit more control in order to do it one at a time. Riz, my man, great question. And Steve, great question as well. Starting with Steve's question, do we want to do in the money? So to do a straddle, you want to do at the money is going to be the straddle that you want to do, right? The at the money straddle is always the cheapest. Okay, the at the money straddle is always the cheapest because it's got the least amount of, it's just all premium. There's no intrinsic value. Now, you can do what's called a strangle. And say we want to do a lemonade strangle. A straddle, we would do the 36s, right? And we know that would cost $9.70 around. A strangle, you can do to lower the cost basis. Let's say you didn't want to buy the 36 calls and buy the 36 puts. What about if you bought the 39 calls and you bought the 34 puts? If you do that, say these are 350, call these 350, that trade's going to be a $7 trade. But instead of being long stock and short stock at 36, you're long stock from 39 and you're short stock from 34. Often in Masters in Trading, we are going to use strangles to lower the cost basis of the trade. That's really the intention of doing a strangle versus doing a straddle. But by the way, I use those words pretty interchangeably. They are the exact same thing with the exact same risk profile. So great questions, guys. Yeah, the only time I wouldn't use a straddle, honestly, for something like lemonade, I don't want to buy a straddle for $9.70. I'd rather buy a strangle for $5 or a good deal cheaper. Great questions, and that's a really cool topic. AAOI. We're going to use an example of here, AAOI, 28 days until expiry. BP, 28 days until expiry. Now, I found two stocks that are trading pretty close to the same level, 34, 30.86. What does it cost to buy stock at $50 in AAOI? Actually, what does it cost to buy stock for $40 in AAOI? Right now, if we wanted to have the option to be long stock at a price of $40 in AAOI, it costs $350 per option contract. If AAOI stays under 40 within the 28 days, these go to zero, right? They're worth absolutely nothing. So AAOI is trading $30, okay? To get long from 40, it costs $350 per contract. Okay. Is that expensive or not expensive? I don't know. But what happens if BP, it's trading $34, 28 days until expiration. If we wanted to get long stock at 40, right? BP is trading at 34. If we wanted to buy stock at 40 in BP over the next 28 days, you know what it's going to cost us, guys? $40? $4. Literally. Boom. What stock has a higher probability of trading above 40? AAOI or BP? What do you think? In the next 28 days, what stock has a higher probability of trading above 40? AAOI or BP? What do you guys think? And we're going to open the options chain, and I'm going to prove to you exactly the odds of AAOI getting in the money. And I'm going to show you that the odds that the market is pricing in. This is cool. How do we do this? Yeah, AAOI is more volatile, but look, you can see if I go to AAOI and if I put on delta, if we look at the delta of these 40 strikes, it's 37, right? So here, let's put this, it's a 37 delta. Delta could be that. I'll write delta. Okay, 37 delta on that 40 strike. What about BP? BP March 40 strike 0.03. So the delta is going to be 0.03 delta. So without a doubt, the market, the math of the market is giving AAOI a 37% chance of trading above 40 within 28 days. On the other hand, the market is giving BP only a 3% chance of trading above 40 in 28 days. That demonstrates the drastic difference in volatility pricing when you have AAOI at 186% vol versus BP at a paltry 30% vol. This is why understanding volatility is so important. Too many trade options without a thought about volatility, and this is a really drastic example of how volatility affects the pricing of options. If you get a chance, guys, watch that back. It's a really, really important topic. Now, the straddle is also the expectation of a stock's movement, right? So we talked about that. We can look at the straddle in something that we call, or the market calls, the expected move. The expected move, each option chain has their own expected move. We look at the expected move for the front month options. And the third Friday of every month, we get a new expected move. So the expected move is from the third Friday to the next third Friday of the month. All options expire on the third Friday of the month. So these are all the straddles for Microsoft, the expectations of movement. Now, the reason the market stays within its expected move is because option traders need to hedge positions outside of these expected moves, so it naturally will cause buying pressure on the bottom of the expected move, and you're going to get selling pressure near the top of the expected move. we can also figure out the probabilities of these names staying within their expected move. Microsoft trades within its expected move 76% over a 3-year period. Some other names, which we can keep just going through, Baba stays within its expected move 78% of the time. Now, this comes in really big handy when stocks revalue themselves, going from 80 to 140, because nobody wants to chase, but it's kind of cool to use the expected move because now Baba, such a strong move, but if it does pull back, 113 is the bottom of that expected move. 113 to 158 are the expectations of movement in these next 30 days. And that helps you manage your expectations for Alibaba. How much can it move? Well, on the upside, 158. On the downside, 113. Stocks at 143. Still quite a bit of wiggle room in there. There's a lot of volatility in Baba. Not sure why Microsoft is on here twice, JR. Here's a cool example of a stock that just gets volatile. Stock's volatile, right? HLIT, not the biggest name, but it still closes within its expected move 80% of the time. Okay? Why does it do that? It's math. There needs to be hedging around those levels because that's where the straddle is for those options. I think retail traders understanding volatility. A lot of people get intimidated by volatility. Here's an important thing to remember. There's really only two things we can bet on, right? We can bet on direction, whether the market goes up or down, whether our stock goes up or down, or we can bet on volatility. We can bet on the expectations of movement. There's a reason why retail traders trade more of direction and professional traders trade more of volatility, the expectation of movement. That's because that's where they go to find edge. Thanks a lot for watching. Really fun week. We'll be back on Monday, 11 a.m. Eastern time. For everybody in our All Access, you guys don't go anywhere. I'm going to open up the Discord, answer any questions you have, go over some of our open positions. Thanks for watching, guys. I'll see you back here Monday.